Good morning, guys. It is Wednesday, January 17th, 2024. This is Bathrobe Business. I'm Georgie Oganov. Let's jump into the news. So we actually have a lot of stories today. Yesterday was kind of a quiet day. I didn't have much to report. It was a really short video. Today I have like a plethora of stories, and I actually had to be pretty choosy. So I'm going to hit them kind of rapid fire because I think there's a lot of important stories here. First thing I'll start with is the market. Dow Jones is down 160, S&P is down 25. NASDAQ is down 117. Oil is actually down to $70 a barrel, $70.87 as it is right now in the pre-market. Gold, my favorite indicator, is down. This is actually really good. So gold is down to $2,026. Now it has been there before, but I think this is a pretty strong fall. And you know me, I talk about gold a lot. I think it's a powerful indicator that's underrepresented in the market. If gold is below 2,000, the economy is good. If gold is above 2,000, the economy is bad. Now, it has been above, it still is above 2,000, but I think that this is a really good sign in that it's so far down. And this is in regards to a story I'm going to talk about in just a second. Well, I guess I'll talk about it now. So it's in regards to Federal Reserve remarks. So Federal Reserve Governor Christopher Waller has asserted that easing of monetary policy may come slower than anticipated. You know me, I am a hawk when it comes to interest rates. That's like 90% of the content, I swear, on this channel at this point is the Federal Reserve and interest rates. Again, reiterating what we have talked about on this channel that mainstream just doesn't seem to talk about, that I don't think a cut in interest rates is coming anytime soon. Definitely not in March. We'll see what the data shows in the late summer, but I don't think that it's coming in the second or first quarter. So yeah, the federal governor has asserted that easing of monetary policy may come much slower than possible. And in regards to that, bond yields are up for the 10-year, and gold is falling as the U.S. dollar has strengthened in regards to that remark. Like I said, I'm going to hit these really rapid fire. So next story, retail sales. This is a breaking news story as of now on CNBC.com. Retail sales are up 0.6 in December. That's actually much higher than anticipated. Expected retail sales were supposed to be 0.4. Remember, in November it was 0.3, so it beat expectations in November. They were estimating 0.2% rise. It was a 0.3% rise. In December, they were anticipating a 0.4% increase. It rose 0.6. So retail sales really topped expectations, and I'm not going to say broke records, but it came in well above what the market estimated. Again, very strong economy. People aren't talking too much about this, but it is still a very strong economy. If you start cutting interest rates in this environment, you're going to spur more inflation. The Fed is looking at this, and they are analyzing these numbers just like we are. Applications for mortgages rose about 9% in this last week. They fell slightly, so the average cost of a mortgage fell from 6.75%. It fell from 6.8% to 6.75%. So a slight drop in mortgage rates. This is actually also on par with what was happening just a week before. So these mortgage rates have been hovering around the high sixes to low sevens for the last month or so. So this isn't unusual, but it's still a very high demand for mortgages. So demand to purchase a home rose 9% for the week. Applications to refinance a home loan rose 11%. The next story I'm going to jump straight into is going to be, I'm probably going to jump into China. So there's some interesting stuff happening with China. So I don't know how much to believe China's news reporting. I guess you could say, how much do we really believe our own reporting? But with China, it's additionally deceptive because there's geopolitical implications here. So China misses their fourth quarter GDP estimates. So GDP for the last 3 months of in China, so for 2023, the fourth quarter, it rose by 5.2%. It did slightly miss analyst estimates that were expecting 5.3% growth. That's why I'm a little concerned. Is it's so close to being true? I don't know if I believe it. 5.2 to 5.3 seems like something China could be manipulating, and the GDP growth could be actually much lower. You might say, well, why would they lie and not just come in at estimates? Well, I guess they could, but a lot of this can be third-party verified through export data. And so I think coming in near where it needs to be is something that's not going to be looked into too deeply. So I would imagine their GDP growth is actually lower than the 5.2 that they are reporting. Retail sales grew by 7.4% in December, but that's also lower than the expectation of 8% that they were expecting. Now, granted, these numbers are still very strong, right? I mean, this is still a very booming economy. Uh, Granted, heavily inflated and backed by the government, but still, we would kind of kill for these numbers. But for China, these numbers are pretty bad. The interesting one is the unemployment rate. So this is something I did not know. So the unemployment rate in China for young people aged 16 to 24 is currently at 14.9%. Earlier this year, I guess earlier last year, it was as high as 20%. And they even stopped reporting that data for almost 6 months, I guess, until as they were recalculating how they report that data. And in the cities, it's as low as 5.1%, but on a national scale, it's as high as 14.9. That's a massive unemployment rate for the numbers that they're outputting. Now, this unemployment rate is really got me fixated simply because I don't know if you guys listen to Peter Zion. I would recommend you do. I don't agree with probably half of what he says, but I do agree with the other half. Why I like his approach is it's based entirely on demographics, geography, mineral supplies, etc. He takes a very pragmatic approach to analyzing the strengths and weaknesses of countries, economies, and international relations. I think it's a very smart way and a very traditional way, maybe mercantilistic is the right word to say, way of looking at geopolitics. But he talks about how China is in its last decade. Now, the problem is he's been talking about this for at least 2 decades, but his biggest citation is the fall in population growth. So China's one-child policy, the fact that they industrialized, moved from from farm areas to urban areas, and because of that, their birth rates plummeted for the last 3, 4, 5, 6 decades. That they're the fastest aging population, not just in the world, but in U.S. history. But that number has me fixated because even if you have a falling population, and they do, that's undeniable. Even in this reporting, as I was looking up, they did have a decrease in the population by 2 million people last year, and that's publicly reported by China. So it's probably again higher than what they're estimating. But if you've got 14.9% unemployment, you've got quite a reserve of labor that you can still use. His biggest thing is that they just don't have the labor reserves to do anything major. I think that 14.9% unemployment is kind of smack dab in the face of that argument because it's got 15% of the population, of the young working population, that has a lot of strength to do major industrial work that could be brought into the market. So I don't think China is as bleak as a lot of people want to put it. I don't want to say optimistic on China, but I think China is much more aggressive than people give it credit for. I think it's still looked at as, oh, they're copycats, they're a lesser economy. I think China is very strong, and I think that 14.9% unemployment rate could end up being a strength in a falling population. Their biggest problem is how quickly they can educate these people and how well and how strong their educational system is into bringing these people into the economy. Next story, again, rapid fire. Trouble for Tesla. So Tesla is slashing car prices in Europe and in China. In Germany, as high as 8%. So they're slashing for two reasons. In China, it's increased competition with BYD. That Chinese, I believe I'm saying that right. I don't think it's Boyd. I think it's BYD. It's the Chinese car manufacturer that is outpacing Tesla sales 2-1. And is becoming the dominant favorite in China. They actually just instituted an AI assisted driving, which is actually pretty big because Tesla's been in this problem for a while. Their whole autonomous driving has been based mostly on traditional programming and algorithms, and now they're actually revamping all that and trying to move into AI much more aggressively. And BYD is already doing that. In Germany, it's a little more complex because part of it is Middle Eastern turmoil. So they had to shut down their plant in Berlin because they cannot get components out through the Red Sea. And because of that, they're trying to clear inventory. But actually, also Volkswagen is kind of mopping the floor with Tesla as well. I did not know this either. So Volkswagen actually surpassed Tesla as the EV king in Germany, and is actually also outselling in the U.S. markets. I did not know that they were outselling in U.S. markets. U.S. automakers last year took a market share of 13.5% of EVs compared to Tesla's 12.1%. So Volkswagen, latecomer in the game, is outpacing it by at least 1.5% in the EV market. And that's with transportation. Those EVs are not being domestically built. So I think this is really, we're entering Tesla's days of reckoning, because Tesla up until this point has moved very much like a startup, very much uninhibited. But now they're actually getting pushback from the market. Another big one is unions, but we'll get to that in a second. But now they are actually facing real competition as these traditional automakers, with all of their industrial power, are moving in on its market share. As EVs have become popular, they are quickly taking their manufacturing lines from traditional combustion to EVs and just crushing Tesla in their production capabilities, because these guys have been doing this for at least 100 years, right? A lot of these companies are older than 100 years, and they have this worked down to the minute. And in addition to that, Tesla is still anti-union. They're still facing a lot of scrutiny here in the United States. And that strike that we reported on in Sweden last year, or late last year, it's been going on for 3 months now, is still unwavering. And remember, they have an ability to strike in a way we don't here in the United States. So they're not just striking at the Tesla plants or Tesla facilities, but across the country. So the post office is not delivering Tesla license plates. Anything that has to do with Tesla, like if you're delivering coffee to the building, it is not being delivered. Garbage service at the building is not happening. Cleaning at the building is not happening. All their unions are linked, and when somebody issues a strike, other unions can strike that individual company in solidarity. That's actually illegal here in the United States and in the UK, but it is not illegal in Sweden, and that's literally what's happening. I think there are at least 40 unions that I know of that are striking in Sweden against Tesla. So Tesla's pressures are growing. They're cutting prices. I'm not saying this is the end for Tesla. I think they're very competitive, but I think this is going to be the next 2-3 years. I think this is going to be the year that Tesla stops that kind of rocket growth and moves into a much slower pace of growth with their model. Last story I'll get to, and this one's interesting. This video ran a lot longer than I thought. So the Biden administration is passing a new ordinance. It's not actually going to take effect until next year, but the Consumer Financial Bureau is banding together to eliminate overdraft fees. So in the last 24 years, I guess since the year 2000, overdraft fees have accounted for $280 billion in bank revenues. So I shouldn't say revenues, but since 2000, American consumers have paid an estimated $280 billion in bank overdraft fees. This new rule moves to eliminate most of those. It's only going to affect about 80% of the banking industry, but that 80% accounts for the grand majority of overdraft fees. So the bank has to have at least $10 billion in assets, but that's at least 175 institutions nationwide. So the rule is going to come in two parts. The individual is going to be able to be opted in. So this whole time, banks were saying that this is a service that they offer to people as a courtesy, because you don't have to worry about getting denied for a purchase. You simply have the ability to continue to purchase, but unfortunately they continue to charge you massive overdraft fees per transaction, per day, and the amounts can stack exponentially. I remember we once had a business account that literally had no activity other than money going in and money going out for a loan. It was the only reason we ever opened the account. And within one day, we racked up $250 in overdraft fees and transaction fees, simply because we, I think, underestimated the rise in the interest rate of that particular loan, and it resulted in a $25 overdraft. But then the fees and interest associated with that rose to $250 within a matter of days. And this is a credible bank. So for a business, this isn't a huge deal. For an individual, that's massive, especially if you're having overdraft fees, you're usually already struggling. So I actually fully endorse this measure. But the reconstruction is going to happen in two parts. One, you can opt in to traditional overdraft fees if you like. However, those fees will be recalculated and be much lower, probably in a $10 to $15 range. The way they're structuring it is it has to be real cost. So the overdraft right now is just a standard fee, whereas the way they're going to restructure it is it's going to be the real cost of the actual cost that the bank incurred to give you that money. So it's probably going to end up being in about a $10 to $14 range. Alternatively, the bank can offer you a line of credit, essentially a line of credit that you will use as a backup for the overdraft. And that will be just estimated based off of your credit score, et cetera, et cetera. I think this move actually isn't aggressive enough. I think it needs to be more aggressive. I think the most simplest measure would be simply, hey, you can opt in for overdraft, or you can just simply say, I don't want overdraft fees. If I don't have the money in the bank, don't approve the transaction. I think that would be the most practical measure. I also think that's a half-assed measure, but something is better than nothing, and so I'll take it. That's literally the last story of the day. This video, like I said, ran pretty long. I got to get to work because I'm late, but I hope you guys have a productive day. I'll see you tomorrow morning.